I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to save you some money. My job is not just to entertain, but to educate, teach, and put days like this in context. Because
if you haven't subscribed yet, make sure you click the subscribe button at the bottom right and subscribe to Growing Wealth and hit the bell icon so you can get our videos in very first moments.
What's happening here with the expectation that the 10-year may continue to go up, how much farther do we have to go down?
So, I think what's interesting is that I think what Needham is saying is that the equity market's sell-off is about chasing yield, which is we have a battle going on between equities and the bond market, because today dividend yields for equities are 1.51% and the dividend and the bond yield is now 1.55%. By the way, just 6 months ago, the equity dividend yield was 3 times higher than the 10-year yield. And the 10-year bond yield. And so what worries me is there's a lot of passive money out there that's been growing over the last 5 years as bond yields continue to decline. And I worry that we don't know what's in those algorithms in terms of asset allocation. So I worry this kind of volatility is going to continue to be a curse of the equity markets now going forward as bond yields rise.
Okay, but let's just play this out, and let's play it for long-term investing, not GameStop today and tomorrow.
Okay.
Do you look at these dips, if you will? Is this a buy the dip situation or not?
So for big tech, I absolutely think it is. I think these stocks are defensive. If you look at my screen, everything's down more than 2% except big tech, because it's hard for big tech to go down 2% because they're trillion-dollar companies. So I like them as a defensive play. Obviously, sometimes like Amazon's been dead money for 6 months because it's a source of money for the reopen trade, because Amazon was such a big beneficiary of COVID that people are selling that one to buy reopen trade kind of names. But no, I like them defensively because they're globally scaled. They are monopolies in the businesses they each created, and they are and they have pricing power. So no, we like them, and they're liquid. Right. So we really like the big tech for those defensive reasons.
Right. I'm sure management doesn't like you calling them monopolies, but investors do.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to save you some money. My job is not just to entertain, but to educate, teach, and put days like this in context, because I know you care and are concerned. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. It was a tough day. I'm talking about a really tough day. I mean, the averages, they were annihilated, all right? Dow plummeting 560 points. S&P plunging 2.45%. And the Nasdaq, sell. Nosediving 3.52%. All for one reason only. Interest rates are soaring. Why? Because the bond market sees the economy getting ready to reopen. Yes, the vaccine. And it figures the last thing we need is more stimulus. To these bond investors, you know what that's like? It's like throwing gasoline on the Kingsfords. They think the economy will overheat, and what happens then? We are going to get some serious inflation.
The house of pain.
Right now, we have a Fed chief, Jay Powell, big heart, who thinks it's nuts to worry about inflation because so many people are out of work because of the pandemic. So he doesn't want to raise rates, especially since inflation has been so low for so long. Hey, look, is he looking at lumber doubling? Like, if you want to do that, okay. Copper, $4.17, maybe. President Biden and his allies in Congress want to pass a huge stimulus package because they want to breathe new life into the economy. As I see it, Powell and Biden are doing the right thing. I don't mind a little inflation now and then, but to bond market investors, they're thinking, are you nuts? The economy's about to start booming thanks to the vaccines, and most consumers are in great shape. Everyone except the people who don't have a job. Unfortunately, there are a lot of people who don't have jobs. As a result, investors are selling bonds, pushing long-term interest rates higher, pushing your mortgage rate higher if you have an ARM. Just checked that this morning. When that happens, stock buyers pull back. They always do. And they pull back hardest on the highest growth stocks, the ones we like the most in Cramerica, but we recognize do get hit in this moment. And that's what happens. That's the high price of inflation. That's what went on today. Case in point. NVIDIA. Last night, this company reported the strongest quarter I have ever seen from NVIDIA. This company's become the dominant player in the semiconductor space like Intel was in the 90s. No one is coming close to them. And whether data center, it is gaming, it's artificial intelligence. Yet the stock got crushed because this is exactly the kind of turbocharged growth story that Wall Street turns against when rates are rising. Now, I think NVIDIA is a victim of short-term thinking. The people who dumped it here, I think, are going to be making a mistake, including the ones who are going to dump it tomorrow. They haven't thought it through.